Hey, what's up guys? John here. Are you planning on investing in distressed real estate? Maybe you want to start and grow a business. Maybe you even want to buy a new truck, a work truck, or a new car, family vehicle. You want to buy something, you want to get a loan. Well, everything is about to change with loans in general in America. It's all changing because of these situations we've seen with Silicon Valley Bank, First Republic Bank. But look at what's going on here. Because so many people are on the sidelines saying, you know what, home prices today, they're too high. Mortgage rates, they're too high. Car prices, too high. I'm going to sit on the sidelines. I'm going to wait because I think there's going to be a big opportunity. Well, that's true. It's 100% true. But if you're not paying attention to what's actually happening behind the scenes, that's all just a dream. It's a dream that's never going to happen. But if you are paying attention to this and you're positioning yourself based on fact, based on what's actually happening, your dreams will become a reality. So please hit the like button. When you hit the like button, YouTube will share this content to educate more people about what's really going on in the U.S. economy. And if you want to fix your credit, we'd love to help you. We'd love to help you. At my company, GreatCreditFast.com. That's GreatCreditFast.com. Go there, book a free strategy session. A free strategy session and see how we can help you fix your credit to position yourself for the greatest wealth transfer of all time. We'd love to help you. So go to GreatCreditFast.com. Take a look at this. So this came out yesterday. New regulations would harm first-time non-white home buyers. So they, especially non-white home buyers, would have a harder time getting mortgages if regulations unveiled this week to strengthen the banking system are approved. This proposal would expand the homeownership gap of people of color, the organization said in a statement, adding that proposals are unnecessary, unwarranted, dramatically impact banks' lending to low and moderate income individuals, particularly in markets where home prices and mortgage rates are at historic highs. Now, this is going to apply mainly to banks with $100 billion in assets, which is a lot of the big banks, right? The average home in America is $429,000, 20% down. Plus, you're going to need to have reserves. You're going to need the lender's going to want to see you have money after you put all this money down, to last 3 to 6 months. So you're gonna need $100,000 cash to buy the average home in America at today's home prices. How many people have that? Not many, because the average down payment, this is not just first-time buyers, but also second-time buyers, second homes, was 10%. The average down payment for a first-time buyer was 6%. So basically, you're gonna have to put down over 3.5% down, or 3.5 times the down payment, because of these new regulations, right? This is going to push a lot of people out of the housing market. 186 banks on the verge of failure, right? That came out about a month and a half ago. Jerome Powell has since increased interest rates, and he's likely going to do it again in September, meaning that this number is only going to get bigger and bigger and bigger. And as consumers have less money on hand, what are they going to do? They're going to start withdrawing more and more and more capital. So these banks are going to become even more fragile. So it's very, very likely we're going to start to see more bank failures and these regulations actually hit. Look at this. This came out yesterday. Banks say conditions for loans to businesses and consumers will keep getting tougher. Now, I've been warning about this. America, it's a beautiful country. I love America, but we heavily depend on credit, whether it be credit cards, whether it be bank loans, refinances, home equity lines of credit, mortgage loans. We really lean into these loans. And without them, this entire country, everything would fall apart. But that's exactly what's happening now, is that they're going to be pushing forward with these new guidelines to make sure that the loans in which they issue are not going to be defaulted on, right? So how do they do that? They're going to be looking at credit. They're going to be looking at really the consumer's profile. They're going to make sure that they're going to be lending money to someone that offers very, very little risk. So look at this. Lending conditions at U.S. banks are tight and likely to get tighter, according to the Federal Reserve survey released yesterday, Monday. The Fed's closely watched the Senior Loan Official Opinion Survey showed that while credit conditions got more strict, demand declined as well. Those results, I'm not sure about that. Those results are important as economists who expect a recession believe that most of the source will be the banking system, which has led to the response of 11 interest rate hikes as well as monetary crisis in March when 3 mid-sized institutions failed. Regarding banks, the outlook for the second half of 2023, banks reported expected further tightening standards on all loan categories. The Fed said in the survey summary, banks' most frequent cited less favorable source of uncertain economic outlook and expected deterioration in collateral values, meaning commercial loans, commercial real estate, a lot of the loans in which they issued, and credit quality of loans as reasons for expected to tighten lending standards overall the remainder of 2023. On the issue of consumer lending, banks reported having tighter standards for credit cards, right? Credit card loans and consumer loans, while a moderate net share reported having done so far for auto loans. Banks also said they're raising minimum level of credit scores when giving personal loans and are lowering credit limits in the $1.9 trillion loan space. I've been saying this for a very, very long time, that credit scores are going to be so important. It's going to be so important. People with 600 credit, 500 credit scores, 400, even low 700s, it's going to be nearly impossible to get a decent loan, because what's ultimately going to happen? I mean, the average credit score in America is a 698. So if you have a credit score in that range and you're applying for credit, then they're talking directly to you, right? The average credit score, they're talking about tightening up credit. Who are they going to tighten up? Bad credit, average credit. They're only going to go for the top tier borrowers. Banks also said they're raising the minimum level of credit scores, right? In the critical 2.76 trillion commercial and industrial lending segment, the survey noted that a major share of banks said that they've seen lower demand for loans amid tightening standards across all business sizes. Commercial real estate also saw a large share of banks saying that they have put more restrictions on standards along with weaker demand. Fed officials say they are aware of conditions in the banking sector, though they continue to raise interest rates to try to bring down inflation. Now, this story to me doesn't make much sense. How do you bring down inflation when they increase the cost of gas, when they increase the cost of energy? Because obviously, if the cost of gas and energy is only going to increase, the cost of everything that's going to be transported in trucks and ships and everything else is just going to get more and more expensive for the distributors, for the manufacturers, and which they're going to push on to consumers. So we're all just going to continue to pay more and more and more. So it to me, it really doesn't make that much sense. If they really wanted to bring down inflation, they wanted to do it aggressively, they would do everything that they could possibly do to decrease the cost of energy. That's what they would be doing. And then we would, we'd see some net benefits of that. And we'd also see a lot of different policies with a lot of the money that we're sending all over the world and all these different things that are happening. I mean, none of it really makes that much sense. At the post-meeting news conference last week, Fed Chair Jerome Powell said he expected the loan survey to be consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and now you got a picture that's pretty tight credit conditions in the economy. Well, look at this. So as that's happening, I mean, regulators unveiled this sweeping changes, $100 billion to banks. Capital One posts 60% profit drop in Q1 as credit card defaults mount. So as these defaults continue to mount, they're going to start cutting limits. Now, a lot of people are saying, hey, John, I'm getting, credit card increases. I'm hearing a lot of people saying I'm getting credit card decreases. I have good credit, but for some reason, I went from a $10,000 limit to a $5,000 limit. So we're starting to see different things all over the place. Fed lifts rates, Powell leaves door open for another one in September. Now look at this, right? So if you're thinking about buying a house right now, let's say, for example, the house is $400 grand. I mean, that's pretty cheap in America nowadays. I mean, the average home is $429. So $400,000, and you're putting 10% down, and you have a 7.5% interest rate. Now, let me show you where interest rates are. If you have the average credit score in America, which is a 698, you're looking at about 8%, right? If you have great credit, I mean, 800 above, it's like 7.2%. So we're just going to use easy math and say 7.5%. I mean, 7.5%. You're looking at $3,000, $3,000 for a $400,000 house. And you still have to maintain the property. You still have expenses as a homeowner, as a property owner. You're going to still need $40,000 down, plus you're going to need some reserves. I mean, that's going to be really challenging for a lot of people. Now, if you want to buy something for maybe around 500 grand, I mean, you're looking at $3,850, right? 38.35, almost $4 grand a month. That's absolutely crazy. It's absolutely crazy. And considering the fact that as of January 2023, report shows that 57% of Americans have less than $1,000, less than $1,000 in savings, almost 60% of the country. So you start to look at this. What do people do? What do people do when they have very little money, they have very, very high debt, and they can't get access to credit? They rent, right? And they also rent out their homes. They try to do whatever they can do to try to make ends meet. So I think that we're going to start seeing rents continue to decline. I mean, look at this. So 42 million residents right now are renting single-family homes. Number of households and residents renting in the U.S. 2020 by structure type. In 2020, there are 14.1 million households or 42 million residents renting single-family homes in the United States. Meanwhile, there's 19 million households or 37 million residents in multifamily with one or more units, right? And the average rent, they're talking about $2 grand in that price point. Why the hell would anyone want to say, hey, I want to be a homeowner. I want to buy a house for $500,000 or for $400,000 and go from spending, $2 grand or $2,200 to spending an extra, 30% more and have the responsibility of maintaining that property and having $40,000 that I have to put down on the property. A lot of people are going to say, I'd rather just rent, right? And I believe that we're going to see rents continue to come down and making that just such a big gap between the cost of ownership compared to the cost of renting. And so I do think it's going to be an incredible opportunity to buy, because there's going to be very, very few people that are going to want to buy. There's going to be very few people that are going to be qualified to buy. And there's going to be a lot of sellers that are simply being pushed to the brink. They have too much debt. They have no leverage. They're not going to be able to get access to credit. They're not going to likely be able to, many of them will probably have a harder time refinancing because they have a very low interest rate, 2, 3, 4% interest rate. And now rates are 7, 7.5%, and credit conditions are tightening. So what are we going to have? You're going to have a situation where you're going to have millions and millions and millions of property owners on cliff's edge. And as inflation, the cost of the world gets more and more expensive, more and more people are getting pushed off cliff's edge. And so the smart and savvy investors are sitting there saying, you know what? Okay, I want to be a player in this game. I need 20% down. I need 750, 770 credit score. I need strong income. I'm talking to a mortgage lender right now, not to buy right now, but talking to a lender right now to kind of see where I need to be a player when, things start to really tighten up. That's what smart and savvy investors are doing right now. They're looking at all this saying, you know what? This is where everything's going. Like, this is where it's all going. I mean, who would have predicted this? 18 months ago, rates at 3%. Now you're somewhere in the 8% range. And most people, they're like, oh, if you have like a 620 credit score, you're like almost at 9%. Anything below that, at 600, 580, like no data available, right? No data available. I mean, so when people look at this, they might say, okay, I pay a little bit more for the interest rate. But what people don't realize is if you have bad credit and you qualify, let's say to buy a home, what these lenders will look at is your debt to income ratio. They'll look at how much money you're pulling in, and they'll look at how much you can actually afford for housing costs. And so if you're paying a lot more for interest, you're going to qualify for a smaller loan. So you're going to end up getting a smaller house for the same money, compared to if you had great credit, you get a bigger house and a bigger investment and a better investment for the same exact monthly cost because you're paying less interest. So this is what we're going to start to see here. We're going to start seeing 20% down as the normal, 20% down. Those who can't put 20% down in a home, right? So look at this. It says the rules would apply to banks with at least $100 billion in assets, which collectively provide a substantial share of home mortgages. It would reduce their flexibility in issuing loans, resulting in more denials for borrowers who cannot put 20% down on a home or have other risk factors, such as bad credit. When you think about it, drop below. Let's have a conversation about this. It's huge. This is major. There's going to be a huge, huge, huge change to the housing market, especially leaving an environment where everyone was getting a loan. Everyone. I mean, you're putting 1% down in some of these cases. I mean, it was so easy. Getting access to money was so easy. Now it's all changing. Drop below, hit the like button, add me on IG, and if you want to fix your credit, we'd love to help you. We'd love to give you a free strategy session, see how we can help fix your credit to position yourself for what will be the greatest wealth transfer of all time. Go to greatcreditfast.com, book a strategy session, and we can see how we can help you. Catch you guys in the next video.